Hi, I'm Chance Finucane, Chief Investment Officer at Oxbow Advisors. With the stock market having appreciated by 9% in the last 1.5 months, new undervalued stocks are hard to find. An alternative solution is adding to some of our existing holdings that have recently returned to undervalued territory. We've recently done this with 2 stocks in our long-term growth strategy and 1 in our high-income portfolio. PayPal peaked at above $300 per share earlier this year, but has recently fallen to just above $200 per share. They're in a multi-year process of phasing out of their longtime partnership with eBay. Last year, eBay represented about 7% of PayPal's total payment volume. This year, it's about 3% of total volumes, and by the end of next year, it should be 0. If we strip out that declining contribution from eBay, PayPal's core revenue growth remains above 20% a year. We think the company can generate earnings per share growth of 20% annually over the next 5 years, and that the share price could double over that period. Charter Communications remains an excellent way to invest in a broadband internet business. The company generates lots of free cash flow that can then be used to buy back their own stock. In the last 5 years, they've reduced their share count by 1/3, and we think over the next 5 years that share count can fall by another 30%. With its valuation having returned to a fair level, and its cash flow per share growth projected to be about 15% a year, this is a position we want to have be larger in our portfolio. We recently increased the size of Unilever in our high income strategy. It has nearly a 4% dividend yield. In general, consumer staples companies have had success raising prices to offset the recent higher cost inflation and preserve their profit margins. Unilever's management is also making a greater effort to use acquisitions and divestitures to improve the quality and growth rate of their portfolio of brands. Historically, Unilever's price-to-earnings ratio has traded at about a 20% premium to the market's PE ratio. But right now, they're trading at a 20% discount to the market PE. We would expect that gap to close over time. We're ready to make new buys if a market correction presents fresh opportunities, but adding to existing holdings is a good alternative in the meantime to improve our portfolios. We hope that gives you an idea of how we're seeing the market, and if you have any questions, please contact us.